So there's been no shortage of all kinds of headlines in the home buying and selling market and industry. And so today I brought in somebody to help try to shed a little bit of light on some of these things, give some insight, some personal takes, let you know what's going on with some of these headlines that you've been seeing and a few other things. So joining me today is Amber Ramos from Palmetto Mortgage Group here in Florence, South Carolina. And she is going to let us know about a couple of these things that we've been seeing. And so to jump right into it for time's sake, Amber, can you tell us a little bit about, let's start with these minimum credit requirements. What's going on with that?
So Fannie Mae, when you think of conventional loans, there's Fannie Mae and Freddie Mac. There's multiple different conventional loans and there's multiple different investors, but Fannie Mae, Freddie Mac are the main government entities that kind of govern everything. They have their own guidelines between Fannie Mae and Freddie Mac, but Fannie Mae has removed their minimum credit score requirements, I believe, as of November 16th was the official date. Um, this can be good for people who don't qualify for FHA, I would say, or if they already have an FHA loan on another house and all they can do is pretty much conventional.
So, practically speaking, people whose credit score may have hindered them for qualifying for a loan previously now, may stand to qualify, at least based on that factor alone, their credit score, because there's no longer a minimum requirement. But the question I got then, I guess, that I think about, what are some of the, there's always pros and cons. So, what's coming along with that?
So I ran some numbers today. The main con is the mortgage insurance. So going down to, I went to a 600 credit score, just 600. And I put in like, I think the purchase price is 220, and I put the average income for Florence County, which was about $56,000. With that data, the rates weren't bad because they qualified for, if they're a first time home buyer, they qualified for LLPAs, which basically removes any extra interest rate charges. Like if somebody has a credit score less than 640, they kind of get hit with a higher interest rate and things like that. So they didn't have all those extra higher interest rates. So the rates for them weren't bad. It was like 6.625 on one that I ran. But when I ran the mortgage insurance for that, it was $355 a month on a $220,000 purchase price. So that's the main thing, I believe, but mortgage insurance is kind of high already when you get down into lower credit scores, no matter what. Like even above 620, it wasn't that much of a difference. It was 291 with the same information. And to compare, if you look at a FHA loan, the mortgage insurance on that, which also goes down to 580 credit score, the mortgage insurance per month is only based on the loan amount, so it's $96 per month. So comparing that to the conventional at a 600 credit score, where it's $355 a month, I would say if you can qualify FHA, definitely go FHA instead of going the conventional route, because I think this will probably only benefit the people who cannot go FHA or any other route and they're at that lower credit score range and need to go conventional. But if they cannot go FHA, this opens a door for them because FHA was everybody's thing to go to for a lower credit score. But FHA got rid of people who have visas. If you have a visa or complicated immigrant status, as in not having a permanent residentship or um, citizenship, residency, you can't do FHA anymore as of May. So I think this might have kind of helped that because people were trying to make money. So they're trying to lower their credit scores to be more in line with FHA for the people who can't do FHA anymore.
Usually, whenever you gain something on one end, you lose something on another, and that's just usually the way that it goes. So, I mean, it sounds like that this is going to open up some opportunities for people that, because some people, a big problem a lot of people have had, particularly because of their credit scores, just can't get into a house. And so maybe they can deal with a slightly inflated monthly payment but they couldn't get in to begin with, and now they can. So the trade off is probably going to be that, though.
Yeah, and then they can refinance later after they fix their
Yeah.
situation. The change with the underwriting system is no longer based on the credit score, it's based on more the credit report, which that is kind of how VA is. VA, they don't have a minimum credit score. They just really focus on what's on the credit report. You could have a lower score, but you haven't had anything derogatory in many years. So it would make sense to approve that person if they haven't had anything recent. It's just the
Right.
score is lower because the credit score system is a little bit wonky. Um, so I do think it opens the door for some people. I haven't personally tried to pre-approve somebody, so I don't know exactly how our automated underwriting system is gonna work with it because I haven't had anybody in the 600 or below 620 range looking for conventional right now, and I can only run DU if I have a hard pull. So it's probably gonna be a minute because I don't hard pull a lot of people's credits. Um, but I guess we'll see how it goes. But I'm thinking it's gonna be more like VA because VA is based on the credit report, not really the credit score.
Okay, well, that's good information. And so we're just glossing over these things. So if you have any further questions or you want to know more, as always, I'm going to put Amber's contact information down in the description of this video, so you can reach out to her at her office and ask any questions that you might have. So the next one is the big one that a lot of people have been talking about since it was brought to our attention is the 50-year mortgage. What can you share about that?
Nothing good. You might think there could be some upsides to this, but it actually does not make any sense at all. And I'll explain why. It has basically got to do with the way interest rates amortize and compound interest over the years. And I'm pretty sure the 30-year mark is there for a reason because that seems to be the sweet spot for the amortization to make sense. Because when I was doing the math for the 50-year, it kind of doesn't make sense for you. I'm going to tell you the numbers and you're going to be like, oh, that doesn't make sense. You probably did your math wrong. I did not. I checked it a couple times because I was like, oh. You probably see on TikTok and Facebook people sharing you how it's going to be a couple $100 lower. The problem is they're all using the same interest rate and they're comparing 6.5 interest rate 30 year, 6.5 interest rate 50 year. And that's the main issue. Because if you know the difference between a 10-year, 20-year, and a 30-year mortgage, they all have different interest rates. 10-year has way lower interest rate than a 30-year because the risk is lower. It's a lower term. The lender takes on less risks, so the interest rate is lower. So what I did this morning is I looked at a 10-year conventional mortgage because I'm going to assume if they did come out with this, it would be conventional because I don't think FHA like HUD would jump on this. Probably would just be a conventional loan, but conventional 10-year loan, the rate was 5.875. That gives you P&I only, principal and interest, just the loan payment, no taxes and insurance included. So we're comparing apples to apples, would be $2,759 a month. You pay $81,181 over the whole term of the loan in interest, just interest. Add 20 years to that, you get the 30-year mortgage. 30-year conventional loan came at 6.825 on the interest rate. I checked this morning, it could be lower. Surprisingly, when I ran rates for the 600 credit score, they had a lower credit score or lower interest rate than this because of the LLPA waiver. Anyways, but it was 6.825. That's about 0.95 basis points difference from the 10-year mortgage. So you add 20 years, you get about 0.95 added to the interest rate. So that's what I did. I was like, okay, 30 year plus 20 years, we'll add the interest rate. But monthly mortgage payment, P&I, on the 30 year is 1633. That's a pretty big difference from the 10 year. So you're going to think, oh, Adding 20 years to the 50 year is going to drop the payment a pretty significant amount. It is not. And total interest for the 30-year mortgage paid over the whole term, if you don't add any extra payments, would be $326,004. Only in interest, not including the mortgage. So adding 20 years to get you to the 50 year, and then adding that 0.95 into the interest rate, because I feel like that's the easiest way to ratio it out to see how it would increase, because it's not a real thing now, so we don't have real legitimate numbers. So that would give us, adding 0.95 to 6.825, that would give us 7.77. With the 50-year amortization, the payment would be $1,655. Mind you, the 30-year was $1,633. The 50-year is $22 higher. And you're thinking, I did my math wrong. But the reason it's higher is all to do with the interest rate and how that compounds and negatively compounds over time since you're paying this off. And with this, because you're paying so little in principal every year, it can't make up for the interest that is added in the loan every year. In a way, it compounds every month, so it's different, but that's the easiest way I can explain it. You're paying about $5,000 a year in principal, but you're paying about almost $15,000 a year in interest. I don't know. We'll have to see. I think the 30-year mortgage is fine where it is.
When you talk about current rates where they are right now, what's the first thing that comes to mind to you? Like how do you view where we are with rates at the moment?
Let me think. I have an FHA loan right now under contract. They're at about 6.5-ish. Not the best credit score, so you can still get around that if you have a little bit lower 600s credit. It's FHA. Um, Conventional, if you are a first time home buyer, your rate is going to be lower. And if you make a little bit less money, I believe the LLPA waiver, it maxes out at like 75,000 a year. Your rate will also probably still be around 6.5, 6.6-ish. They are decreasing. We're praying and hoping and praying that they continue to decrease. From what I hear, as long as everybody is agreeing in the White House and the Fed chair and they stop arguing about everything, the rates will continue to go down because inflation is calming down a little bit. The data reports for like the workforce and all that plays into effect when it comes into interest rates. When you see on the news that the Fed has lowered rates by 0.25%, everybody likes to text their mortgage lender, me, and ask me if their rate is a quarter less. And I'm like, no. It takes a little bit for it to go into effect after the rate drop happens. Or sometimes what happens is the lenders will predict that the rates are going to go lower, and we kind of lower our rates before they drop it. So by the time they have that meeting, our rates have already lowered in anticipation of that. But everything can affect your interest rate, your DTI, how much money you have saved up in reserves, your income, all type of things. We have certain programs that give you a lower interest rate if you do energy efficient things in your house. You will get the same LLPA waiver, and that gives you a cheaper interest rate if you go conventional. I do a lot of SC housing loans. SC housing, whether you have down payment assistance or not down payment assistance, you get a way lower interest rate. If you have the down payment assistance, I believe it's like 5.875, and if you don't, it's 4.875, and it's a great interest rate, but you have to deal with SC housing. I've done a couple of those recently, and it's not very fast with the holidays right now, but the interest rate is worth it. Well, just in a short sentence, rates are going down, and they should be continuing to go down into next year.
And they are lower than they have really overall been in quite a while too.
It's almost at, I know it's past the 2-year low. I saw something about it
Yeah.
almost being towards the 3.
Yeah. So, I mean, a lot of people, there's a lot of negative conversation, but I mean, that's something I found myself saying over the last couple months. Like, well, I mean, they are lower than I guess people just kind of like, I think that magic number is like 5%. And everybody looks at that and just thinks like everybody had 5% or 4. And so they're comparing to that, but I mean, it's lower than it's been. So that's a positive.
Because there's, I think they said like half of people with mortgages right now, or over half, have like a 2% or 3% interest rate. And that's crazy. I wish I had that.
But when you're comparing it to that, then you don't realize, it's like, okay, but we're still in a better position we were 24 months ago or whatever. So, all right. And so the last thing, just while we've got you here, are there any programs at your office that you'd like to share? Anything that would be helpful for somebody to know that may be home shopping or considering home shopping that you think they should know about?
At our office, we are the Palmetto Mortgage Group, but we are under Cross Country Mortgage technically. We are like the number one retail lender in the company, or not the company, the country, because we do only mortgage loans. Like Rocket Mortgage, they're kind of different. They're a telemarketer mortgage company, so we don't compete against them. But anyways, we have more programs than any other mortgage company that there is right now. Um, so I do multiple different types of down payment assistance programs. We have about 3 that are active right now. There are some better ones that are not active at the moment, but they should become active again next year. So if you're planning on buying next year and you're thinking about it and you know that you need down payment assistance, probably reach out to me so we could plan accordingly. Um, we go down to a 500 credit score. It's not always the cheapest. Sometimes it's 10% down, but sometimes people have 10% down and they don't want to fix their credit and deal with that and they just need to be in the house. So that can be helpful. We do a lot of loans for self employed people. If you can't qualify because your taxes or something like that, we have all types of options. Just anything, anything. If you think about it, if you've heard about it, we have that loan program. Um, I'm all for people preparing in advance to be able to buy a house. So you can call me, we can have a quick conversation. I can help you on your credit. I don't do hard pulls up front. So you can figure out what you need to do, and we could see your whole credit profile, your income, your assets, and get you a full plan so you know what you need to do and you're not out here just following TikTok and Facebook and all of that and listening to their bad advice. And you could probably save a bunch of money.
All right. Well, Amber, thank you so much for your time. I appreciate it. Hopefully, this was informative and helpful. Try to make it straight to the point. I don't know if it answered any of your questions or not. If you do have any other questions, like I said earlier, this is Amber Ramos with Palmetto Mortgage Group. Her contact information is down in the description, so you can give her a call. Ask any questions that you have. As always, appreciate y'all's viewership. God willing, we'll see you in the next video.